Hey guys, Toby Mathis here, and today we're going to dive into extensions, tax payments, what quarterly payments are, why we do them, how it relates to last year's tax, what the safe harbor is, why there are 3 penalties we have to worry about, plus interest that goes on top of lots of the penalties. So we're going to cover them all today and dive in. Before we get started, I'm Toby Mathis, one of the founders of Anderson Business Advisors. Been doing this close to 30 years, and I'm going to talk to you exactly like I talk to our clients. And we're going to dive into what the nuances are so that you understand what quarterlies are, why we pay them, the amount of quarterly you should be paying. If you don't pay quarterlies, are there safe harbors to avoid penalties and interest? What are the penalties and interest? What are the failure to file penalties versus what are the failure to pay penalties? And how I can make sure that the IRS isn't reaching into my pocket and taking out dollars. So we're going to dive right on in. All right, so we're going to talk about the safe harbor, extensions, tax penalties, and what you are probably getting wrong today. I'm going to do this in presentation style. But the first thing I want to cover, the 10,000-foot view, is that when you pay taxes is different than when tax returns are due. And if you understand that simple concept, it's going to make everything easier. Your taxes aren't like your tax returns. The filing date might be April 15th. You could get an extension on that and move it out to October 15th, which is what we recommend our clients do for a number of reasons, because K-1s get issued later on a lot of the investments that our clients are in, because you get restated financials, because by filing on April 15th, sometimes you freeze yourself out on the ability to do certain types of tax planning. For example, if you have a small business, you can continue to contribute to a 401k, cash balance plan, DB plan, all the way up until you file that return for that business. We can be doing cost saves all the way up until you file your return plus extension. So there's lots of reasons why we do extensions to give ourselves that breathing room. The most important reason is because it gives us the chance to get it done right and not have to go through and amend and restate returns if somebody reissues a 1099 or a K-1, which, by the way, happens all the time. And if you guys remember when when the brokerage houses were required to start reporting basis that first year, it seemed like everybody was restating not once or twice, but like multiple times. They were having to restate financials, the 1099s and the tax reporting, and it was just a nightmare. And if somebody had filed on time, then they were going back and having to amend sometimes once, sometimes twice, sometimes more. And it was just like really frustrating. If you just use the extension that's available to you, you can do that. And for an individual, everybody's actual due date, the drop dead, is October 15th. The initial date is April 15th, but you get an automatic 6-month extension. It's kind of like if the teacher said your homework is due on Friday, or you could just wait till next Tuesday if you want. And you're saying, oh, I'll do it on Friday. I get it. You want to get it done. But you have up until Tuesday. And if things had changed, let's say you were doing a report on some sort of commodities pricing or something, and then all of a sudden something drastically changed you turned it in on Friday, and on Monday something drastically changed, and you still had time to fix your report, it is too late now because you turned it in. So we like to give ourselves that little bit of breathing room, and at Anderson, that's what we recommend with folks, not just because it's the prudent thing to do, but because so many of our clients are investors, and so often, if you're like me, people are rushing to get their K-1s out the door on their investments, or they're rushing to get their financials done so that they can do and make an estimate or get an idea what those numbers are and get a K-1 out the door or get your numbers on your Schedule E. And then in the months following, you realize certain things were either done incorrectly or left off or something changed, or hey, maybe there's some tax planning we can do. Maybe the economy shifted and I have more cash now that maybe I could put away into a different type of retirement plan, but you closed the door because you filed that return too quick. So we like to keep that door open. Now, let's jump in because this is an area that is very misunderstood. Let's talk about the 4 traps that are out there. There are 3 penalties that we need to be aware of, and we also have interest that gets charged on it. It's not a penalty in and of itself, but it is often charged on the taxes and sometimes on the penalties themselves as well. Depends on what type of penalty it is. So I'm going to start right off the top. The one you never want to get hit by is the failure to file penalty. This is, I didn't file an extension, I didn't file my return on April 15th. I am going to get nailed with a 5% per month penalty on the unpaid tax. That is critical. Now, by the way, did you hear what I just said on the unpaid tax? If you've paid all your taxes, then it doesn't actually hurt you. But if you owe taxes, let's say you owed $20,000 in taxes, 5% per month, ooh, that's going to start to weigh. And that gets assessed up to 25% of the tax that's due and owing. So in this particular case, $20,000, if I have a 5%, that sounds like, what is that, $1,000 a month. For 5 months, that's $5,000. Ouch, right? That is one we want to avoid. Filing the extension gets you away. There's no excuse to get hit with that failure to file penalty. You need to be making sure your extensions are done. Failure to pay. This is the one that trips people up. A lot of times they think, well, I filed my extension, therefore I have until October 15th to pay my tax. That is not true. If you have tax due and owing on April 15th and you do not pay it, then you pay about 0.5% per month in unpaid taxes. Now, this gets reduced if you have a failure to file and the failure to pay. It is capped at that 5% and at that 25% number. So if you can do math, like, hey, if we're capped on the failure to file, then once we hit, let's use my example of $20,000, once we're capped at 25% of that, or $5,000, then after that, we continue to get the failure to pay penalty until it's paid. Ouch, right? So it goes down to that 0.5% per month. These things are calculated typically on a daily basis. Underpayment of estimated tax payment. This is the one that trips people up all the time. You owe taxes as you go. Now, if you're an employee, you know that your employer does withholding, so you're probably never worried about it. But if you are an investor or if you have other income, you're supposed to pay those taxes as they come due. And there is a get out of jail free card as long as you're paying 90% of the current tax owed or 100% of last year and you're under $150,000 of adjusted gross income. If you're over $150,000 of adjusted gross income, then it's technically 110% of last year's tax, and then you don't have to worry about this. So let's just say that you owed $20,000 last year of tax, and we're paying it quarterly, and your accountant says, hey, just pay $5,000. You can get away from ever worrying about the underpayment of tax penalty if you pay that, as long as you are under $150,000 of adjusted gross income. You could pay 100% of the amount, or you pay 90% of the current tax due. So if you are paying that $20,000 and your tax ends up being the exact same, hey, you owe $20,000 this year, but you paid $5,000, $5,000, $5,000, $5,000, you paid your quarterlies, whatever the amount is, as you went, you would not get hit with this penalty. Unfortunately, what a lot of people realize is that when you have investments, sometimes the taxes come in irregularly. And so maybe in January you sold a bunch of stock and you had a bunch of gain and you didn't owe $20,000. You owed $30,000. And I'll use some examples here in a minute, but let's just use that as a simple example. I owe $30,000 in tax. Now, that estimated tax payment really matters. If I paid $20,000 throughout the year, notice that I'm not even close to 90% of the total tax. I had a little bit of a windfall in January, and I owe $30,000 in tax, and now I'm going to pay underpayment of estimated tax, so the underpayment penalty, all the way back, going back to January. I was due on the first quarter, which we're going to be looking at April 15th, or whatever the first quarter ends, the due date, the tax due date on that, and I'm going to incur penalties for not having paid that. Now, the get out of jail free card on that one is if we just paid 110% of last year. So let's go back to my example. We owed $20,000. I'm going to assume you're above $150,000 a year in adjusted gross income. And we have this big windfall that creates an extra $10,000 in tax. So last year we owed 20. This year we're going to owe 30, but we don't have a crystal ball, so we don't know necessarily. And this is in January. So how do we make sure we don't get tripped up by this? You pay 110% on a quarterly basis of last year's tax. What was last year's tax? $20,000. So if we just pay $22,000 quarterly throughout the year, then we can avoid this underpayment of estimated tax penalty. If you don't do that 110, if you just did the 100%, it doesn't get you, now all of a sudden we have an underpayment of tax penalty going all the way back to when it was due in that first quarter. And that's why it's so important to work with your accountant. When you see that on your tax return, and you have an accountant do your tax return and they say, here's your vouchers for paying next year. And you do what a lot of people do. You put it in a drawer and you forget about it. You should instead be looking at those quarterly tax payments and saying, is this 100% or is this 110%? Because if your income is going up and you're above that 150, or you're in danger of going above that $150,000 of adjusted gross income, make sure you are paying the 110%. And the tax software has a little clicker on it like, hey, is it 100% or is it 110%? Make sure that you are paying 110%. And if in doubt, and you're having a great year, pay a little extra. And the reason being is so that you don't get hit on this. Now, a lot of you guys are thinking April 15th, April 15th. That is where we start looking at that failure to pay penalty. So using my same example, we owed 20, now we owe 30. We owe $30,000 of tax total. So let's say you paid 20 throughout the year in your quarterlies and you have another 10,000. You owe that on April 15th. If you don't pay that, you have a failure to pay penalty, plus you have the next category, which is interest. You're not going to have underpayment anymore because it gets shut off on April 15th. That underpayment penalty, that's its last day. Everything else is from April 15th beyond. So when you start hearing people start talking about these penalties, you understand there are three penalties. There's the underpayment penalty for not paying throughout the year. There's the failure to pay penalty on April 15th. And there's the failure to file penalty. The safe harbor you always hear people talk about, and I'm going to go over this again over and over again, is related to that underpayment penalty. Nothing gets you out of owing your tax. You don't get a magic reprieve on failure to pay your tax when it's due after April 15th. If you owe taxes after April 15th, so April 16th onward, you're going to get hit with that failure to pay penalty. Hopefully you filed an extension so you don't have to worry about the failure to file. And you're going to get hit with this next category, which is interest. It is not a penalty. Interest is charged on taxes, interest, and penalties. It continues to compound. This is a compounder, and it accrues daily. So it's like, this gets pretty nasty, and it tends to, every quarter, I think they're putting this thing out of what the interest is, but I think it's 3 percentage points over the federal short-term rate. So right now, I think it's right around 7%. Sometimes it drifts up to 8, but you can look in it, generally you can go look it up and see what it is at the time that you are filing, so you can see what the interest is. The IRS is going to send you a bill regardless, and they're just going to calculate it. All right, let's talk about scenarios so that this makes sense. I'm just going to use a scenario of Mark, and let's just say Mark had a great year, smart guy, right? High income. His federal tax bill was $30,000. This year, it's coming out to $50,000, and I'm just going to say he had this little surprise gap, this $20,000. Let's say he incurred that in January, so he's doing very good. You know, here's Mark's a smart guy. He's making lots of money, and he says, if I file on extensions and paid what I paid last year, the $30,000, am I good? Let's walk you through this, and it depends. You're going to get hit with the penalty because if he pays 30, but he still owes 20, he has a failure to pay penalty plus he has interest. If he filed an extension, he no longer has the failure to file. We're going to go through each one of these. And then it depends on how much he actually paid as to whether he had an underpayment penalty on top of it all. So he could technically get hit with all 4 things. He could get all 3 penalties, plus he could get interest on top of it. So let's take a look and see what his options are. And let's go over each one of the penalties. So the first bucket, the failure to file penalty. This is the expensive one. This is the one where you're charged 5% per month. Ouch, for filing late. That's 10 times the late payment rate, but it is capped at 25%. So it's 5 months at 5%, and you're done with the failure to file penalty. You still have these other ones going. Bucket number 2, the failure to pay. Failure to pay just means, hey, April 15th arrives and you still owe money. So in Mark's case, he owed 20 grand, right? So he's still going to owe this 0.5% per month. That's unpaid, and it's compounding interest. It's like, ooh, it is, you're going to get hit. This thing compounds, the failure to pay penalty compounds daily, plus you owe interest on it as well. Bucket number 3, underpayment of tax penalty. This is, I owed taxes as I went throughout the year, but I did not pay them. I did not pay my quarterly tax amount, and I end up getting hit with this underpayment penalty. That's the one that we want to make sure that if we're paying quarterlies and we're in the safe harbor, we can avoid easy. But if using this real easy, when are your quarterly taxes due? First quarter is April 15th. Second quarter is June 15th. If that sounds weird because you have April and May, that doesn't sound like a quarter. It's because the government makes their quarters not 3 months. They do this weird thing where they say January, February, March is quarter 1, and then May and June are going to be our second, or April and May, excuse me. So you have January, February, March, and then you have April and May as second quarter. And then you have another quarter, which is going to be, what do we have? If we did April and May, then we have June, July, August as another quarter. That's due on September 15th. And then you have the rest of the year after that. What do we have? September, October, November, and December. So we have 4 months at the end of the year as the quarter 4. And that's payable on January 15th. So if you're doing this at home, right, we have April 15th is quarter 1. So quarter 1 is 4/15. Quarter 2, what do we have on that one? We're looking at 5/15. Quarter 3 would be 9/15, and quarter 4 is 1/15 of the following year. Oy, right? That's why you use your vouchers. That's why you mail them in when they're due. All right, so let's go over scenarios, because I want to make sure the underpayment penalty really makes sense. We have to make our quarterly payments throughout the year. So let's do a scenario. Mark says, hey, I want to make sure that I pay, and if you remember, he paid $30,000 in the previous year. He owes $50,000 this year. So it's $30,000. In order for him to escape the underpayment penalty, he would need to pay 110% of that. But this is the part that people mess up. He needs to pay that 100%, 110% quarterly. He paid no quarterlies throughout the year, but he pays $33,000 by April 15th. What did he just do? He did nothing to help himself on the underpayment penalty. This is the part you have to understand. If you did not pay into your quarterly payments, and all you have to do is hit that 110%. So all he had to do is pay $33,000 divided into the quarters, and he would avoid the underpayment penalty. Let's assume that Mark paid $30,000 quarterly. His accountant just used last year and just said, hey, just pay that. And he's over $150,000 of adjusted gross income. He is still going to get hit with the underpayment penalty. So now he's going to owe $17,000 because he paid $33,000 and he owes $50,000. So we just take the 33 off of that, and so he owes that. We know that. He's going to get hit with the underpayment of tax penalty plus interest, plus he's going to get the underpayment penalty for not paying in quarterly. And that's going to be roughly 7-8%, whatever that ends up being. It's published out on a quarterly basis, I believe. So he's going to get hit with whatever that underpayment penalty is, plus he's going to get hit with the 0.5%, the 0.5% for the failure to pay, plus he's going to get interest on top of it. Oy. But where he did make a good decision is he did not file late. He filed an extension and he made his payment. And this is huge, because if he did not pay and file at the same time, if he did no extension and he has that filing late penalty, that's the 5% a month. That's what toasts you. It's not even close. It's 10 times the amount. And it's duplicative. In other words, you get the failure to pay and you get the failure to file. And it gets you to that 5%. Once you get to the 25%, then that, I guess you would say 4.5% goes away because you still have the failure to pay, and then you still have interest on everything. This is where it gets really nasty quick. So let's go through this. So we know that we have these penalties out there. And if you remember, there's 3 penalties: failure to file, failure to pay estimates, underpayment penalty. And then the 4th thing is interest. So always be thinking there's 3 things. The underpayment, the failure to pay your quarterly payments as they're due and owing throughout the year, you can actually do a safe harbor. And here are the ways to avoid that underpayment of tax penalty. This is it, standard. You avoid the underpayment if you pay at least 90% of the current year tax of the current year. So if your taxes go down, this one might be beneficial for you. Or if your taxes go up slightly, this one might hit. Or you paid 100% of last year's tax. I'm going to say our safe harbor for Anderson is always going to be 125%. I'm just going to plant that now. We'll go back to it. But what we recommend is people, especially if they're on a growth trajectory, they're paying 125%. Now, if you are over $150,000, then that 100% threshold goes up to 110%. So for Mark, 110%, he owed $30,000 last year. He now owes $33,000, and he needs to pay that quarterly. As long as he does that, even if he owes a ton of tax at the end of the year, he avoids the underpayment tax. And I want to repeat that. Even if you have a huge taxable event in April, hey, and it's early on in the year and you owe a ton of tax, even at $100,000, it does not matter. The underpayment penalty can be avoided by doing the safe harbor, which is 110% of last year. You pay that quarterly, you're not getting hit with this tax. What it is not a payoff quote or a crystal ball, right? You still owe the tax. So Mark's case, remember Mark's scenario, he paid $30,000 last year in tax. This year he owes $50,000. So he owes $50K. He paid $33,000 throughout the year quarterly. Okay, so he does not get hit with the underpayment tax, even though he owes $17,000. But he owes that $17,000 on 4/15, period. If he does not pay that $17,000 on 4/15, even if he files an extension, he knows he's going to owe some tax, but he does not pay it, he's going to get hit with 2 things: failure to pay, which is 0.5%, and interest, which gets published, and is right around 7 or 8% right now. So it depends on the particular months and quarters, things like that. But he's going to get hit with the penalty and the interest on just the $17,000. I hope that makes sense. We're going to go through it a couple more times. So the big critical numbers for Mark, remember, Mark paid $30,000 last year. He owes $50,000 this year. How can he avoid getting hit with something? Well, his safe harbor is $33,000. 110% of 30 is $33,000. That keeps you from having to worry about the having to pay, as long as you paid it on a quarterly basis. Or he could pay 90% of the actual tax, and that will reduce his exposure to late payments as well. So if he pays 90% of the actual tax or 110% of last year's, he's in the safe harbor. If he wants to avoid anything, assuming that he made his quarterly payments, pay your $50,000 by April 15th, and now you owe nothing to the IRS. So each number is something different. Now, what if Mark does nothing? He sits on his hands. That'll be our first scenario. So remember, he has $30,000 last year. He owes $50,000 this year. So that $50,000 is going to be our big number. He is going to owe 25% or 5% per month for failure to file up to $12,500. That's his penalty. $12,500 is 25% of $50,000. So he's going to get hit with the failure to file. He does nothing. April 15th comes and goes and he files nothing. He doesn't make any payments throughout the year. He doesn't do anything. He doesn't even file an extension. He's going to get hit with that pretty nasty penalty, 5%. Now, by the way, this is of the tax owing. So people are always saying, but what if I owe no tax? Then no harm, no foul. Technically, you're supposed to file, but if you owe no tax, then you actually don't have a filing requirement. But I don't want to get into that. I want to talk about reality here, which is our clients make good money. They owe taxes. Sometimes they have great years. Sometimes they have pullback years. But you always file an extension. Always. Because it keeps you away from this failure to file penalty. I do have situations where people have not filed because they didn't think they owed anything. And then during the summer, they're doing their finances and they realize they forgot something, or they took a position that depreciation that wasn't actually there, or they did the wrong amount, or their accountant didn't know what the rule was on bonus depreciation during that particular year, and they ended up with a tax liability. And they get hit with the failure to file, plus the failure to pay, the underpayment penalty and interest, and they get hit with all four. In this particular case, Mark gets hit with the failure to file. He didn't pay anything, so he's going to get hit with that failure to pay. And if you remember what I said earlier, if you have failure to file and failure to pay, for the first 5 months, it's 5% cumulative. After that 5 months, you've maxed out the 25% of the failure to file, and we just have the failure to pay, which is 0.5% per month. You also have the estimated tax underpayment penalty. You didn't make payments throughout the year, and in Mark's case, depends on which quarter it should have been calculated. He's going to end up with the penalty there as well, which, by the way, there's just that penalty. There's not penalty and interest on the underpayment. It's just the penalty. It's around 7%. And so he would be paying tax on that of when he should have paid it. And then you have interest on top of all the taxes owed and the penalties. So whatever it is, April 15th comes, that interest now is starting to loom on the unpaid balance. So for Mark, every dollar that he owes, everything, penalty, all of his taxes, so the $50,000 plus the penalties he gets plus the interest, all of it's going to compound daily on interest. So it can be a very painful situation for Mark. So if he does nothing, he's really getting hit. Scenario 2, Mark files an extension and he pays $30,000 along with that extension. So he sends in $30,000, the amount he owes last year, and he thinks, okay, I'm good. I'm in the safe harbor, aren't I? Like, didn't I pay 100%? Well, you remember, the high income, if you're over 150,000, which Mark's definitely going to be, he would have to pay 110%, and that's just for the underpayment penalty for what occurred during the year. Once we hit April 15th, we're done. We're not worried about that anymore. What we are worried about is how much do you owe and what are the penalties on that. So in Mark's case, he paid $30,000, he owes $50,000. So he owes a whopping $20,000 balance. So what is he going to get hit with? He filed an extension so he doesn't get failure to file. Whew, this is good. He avoided getting hit with that. But he failed to pay. He owes $20,000 on a balance. So he's going to get the failure to pay penalty of 0.5% per month. He's also going to get the interest, and he is going to get an underpayment penalty. So even if he paid the $30,000 throughout the year, he paid it quarterly, he did not equal 110%. So whatever amount that he is short on, he is going to get hit with the underpayment penalty. So he was $3,000 shy, but he's going to get hit on the underpayment on the entire tax that was due. So let's assume that his $20,000 tax liability was incurred in the first quarter. He is going to be paying taxes, or a penalty, I should say, the underpayment penalty on that money that was owed from that first quarter on. Hope that makes sense. I'm going to keep diving into this until we all get it. Scenario 3, Mark files an extension and he pays $33,000. And let's just assume that he paid it throughout the year. So what is he going to get? He's not going to get hit with the failure to pay, or the failure to file, excuse me. He doesn't get hit with the failure to file penalty because he filed an extension. The underpayment penalty, because he paid the 33% throughout the year, so, or the 110%, so the $33,000 throughout the year, he paid 110% of the previous year, because remember it was $30,000 previous year. He owes $50,000 this year, but he paid $33,000, so he owes $17,000. On April 15th, guess what he starts paying? Failure to pay and interest. He doesn't have to worry about the underpayment penalty because he paid his quarterlies. He doesn't have to worry about the failure to file. He is okay because he filed an extension. But he's definitely going to be starting the clock on the interest and the failure to pay. It's always about timing. When you pay matters almost as much as how much, right? So withholding, when you're an employee, that always wins because somebody's taking your taxes out, and usually you're owed money. Sometimes you owe a little bit of money, but you've been doing your withholding, you're going to be fine. Quarterly estimates, this is your get-out-of-jail-free card on the underpayment penalty. So remember, this is your 100% or 110% if you're over 150 grand, or 90% of the tax payment. If you are paying those, you do not have underpayment penalty. Annualized method, this is kind of a tricky one. I'm not going to jump too far into it, but if you are like in an S Corp and you're paying yourself a salary and you don't want to have to worry about, oops, I didn't make enough payments, at the end of the year you can annualize it and you can jump up and pay one big withholding and avoid getting hit with the tax. All right, so let's talk about what smart taxpayers do. They know what last year's tax liability is. They look at their tax return, or they go to the irs.gov and they pull it up and they know what that number is. So with Mark, remember we had a $30,000. Yours is going to be different, whatever that is. They don't confuse that there's a safe harbor with I paid it in full. They pay their quarterlies, and they make sure that if they're a high income person over the $150,000, they are making payments on a quarterly basis and making sure that they don't get hit with that underpayment. But they also know that even if they can avoid the underpayment penalty, that's not the same thing as being paid in full. Paid in full, in Mark's case, was $50,000. The safe harbor was $33,000. They don't confuse these two things. Even if you paid $33,000, you're not paid. You still owe $17,000. The other thing smart taxpayers do is they file an extension. Even if the return is ready, and they could, unless they have to file that return for a loan or they're owed a bunch of money back from the IRS, I would file an extension. If I am going to owe money, or if I have complexity in my return and I don't want to have to amend my return, I am filing an extension. I personally file an extension every single year, and people like me do that. People like you probably should be doing that too. We also pay something meaningful at April 15th. If you are not sure and you have a lot of moving pieces, you have lots of investments, our recommendation is that you always pay 125% of last year's tax, whatever that might be, on April 15th. So if you, again, so using Mark as an example, what we would have said to Mark is, hey Mark, I know that we don't know what your taxes are, and maybe there's some moving pieces, maybe he still has some tax strategies, and maybe he's not going to owe that $50K because we're going to do a cost seg, or we're going to make a contribution to an employer plan like a 401K, or we're going to do a DB or something. But whatever the case, if he paid $30,000 last year, we would be paying something like $37,500 just to make sure that whatever the amount of the underpayment isn't so huge that it leaves a mark. Because remember, underpayment penalty, 0.5% per month plus the interest, and that interest payment is somewhere between 7 and 8% right now. So you get both. So you're like, oh goodness, I have 6% plus 7%, I'm paying 13%. Some of you guys might say, that's a great loan, I'll take it. And you're not worried about it. Just do it with your eyes open. And then the other thing is to look at your withholding strategically. You can always be looking at, like, especially if you run your own business, that you could do something in the fourth quarter and run a larger payroll with most of it sent to withholding, and like all of it sent to withholding in some cases, so that you do not get hit with the underpayment penalty, especially if you have your own business and maybe you had a really great year. But smart people know this stuff exists, work with their accountant to make sure that they don't get hit. So, simplest summary possible. We have things that we need to be aware of. The safe harbor, let's make sure we can get away from that underpayment penalty throughout the year. Right, this is how we do it. We do 110% of last year paid quarterly. You don't have to worry about underpayment penalty, period. So even if you owe $100,000 and last year you paid 30, as long as you pay 33 quarterly, you can get away from that underpayment penalty. That's the big one. Then if you file the extension, you never have to worry about a failure to file penalty, assuming that you file your tax return on October 15th. And that's why you always file your tax return, because you don't want to get hit with a failure to file penalty because it's so stinking good, high. So even if you're doing your best to estimate, right, hey, file your extension, and even if you still have questions when it comes time, work with your accountant, get something filed, please. And then balance due. Whatever, on April 15th, the underpayment stuff goes away. So you have that underpayment penalty up until April 15th. After April 15th, it's failure to file penalty, which is that 0.5%, and your interest. That's it. So if you can kind of get those things and you're like, you're not really protected from any penalties or interest until you fully paid your tax liability. And some people, we don't know what our tax liability is until later, and so you do. You got to be looking at back in the future, and you're going to get hit with some things if you didn't make payments as you went along. That's why you always pay something meaningful on April 15th. If you have to get a refund, go for it. Yay. But I don't want to be in a situation where, unbeknownst to me, I didn't mean to, but I triggered some penalties because I ended up owing tax that I didn't know that I owed, or I hadn't made my final decision as to how I was going to treat certain things. Maybe I was on the verge of doing a cost seg and it could save me some money, and I decided, wait, I'm not going to do it for last year, I'm going to do it for this year. And then last year, that, because I didn't make any payments in, now I'm triggering late payment penalty, failure to pay penalty, and I'm getting interest on top of it. You should never get the failure to file penalty because you're always doing an extension. But we still have to be aware, hey, if I create a tax liability and I hadn't paid it, then I could be having an issue. All right, the 4 things that we look at: Remember, there's 3 penalties. Failure to make your estimated payments, so the underpayment penalty, and this one is for not doing your quarterlies or not paying taxes as they're due throughout the year. This is the one we could avoid with the safe harbor. So if you just pay your quarterlies at 110% of last year's tax liability, you never have to worry about this one. So for all of you guys out there, look at your tax coupons, make your quarterly payments. You never have to worry about this one. This one, the underpayment penalty, goes away April 15th, because then you shift into the new ones, the other 2. Failure to file, which you should never get hit with because you're going to file an extension and you're going to file your tax return on October 15th. And the other one is failure to pay. The failure to pay penalty trips people up a lot because they think the safe harbor and that are the same thing. No, the failure to pay penalty starts April 16th. The underpayment is prior to that. You're in again, and then you have interest on top of the whole shebang. The interest comes in, it's not actually assessed on the underpayment, it's just that underpayment penalty is it's usually around 7%. Again, they post it. But the interest gets added to all the failure to file and the failure to pay penalties. So whatever your tax is due and owing, you get to add that interest on it as well. All right, I threw a whole bunch at you guys. Ask questions in the comments or reach out to us with any questions that you might have so that we can give you the best guidance. At Anderson, our position is really easy. Pay your quarterlies at 110% last year if you're high income, or if you're below $150,000, pay 100% of last year. It's too tough to do that 90% safe harbor because we don't know what your taxes are going to be, because a lot of times we have options. Long after the year is over, sometimes we are making that decision in September or October of the following year. So if you want to do the safe harbor, the best thing I could tell you is pay 110% of last year's tax on a quarterly basis. You don't have to worry about the underpayment. And then we say pay 125% of whatever last year's tax was by April 15th so that we can minimize that failure to pay and failure to file penalty. You should never get hit with the failure to file, but so we can minimize the failure to pay penalty and interest. You do those things and you're going to be much better off as a taxpayer. And as always, put your comments down below or reach out if you have questions. I'll put a link in there if you need a strategy session. Thanks, guys.